Imagine you're a global fund manager in New York. You want to allocate capital across the developing world, building a portfolio that captures the growth of economies like India, China, and Brazil. You probably aren't picking individual stocks to do this. The standard route is to buy a single vehicle that does the diversifying for you, the MSCI Emerging Markets Index. The index uses free float market capitalization. Like gravity, the largest companies get the heaviest weights. Yet, for the first time since 2000, Indian companies vanished from the top 10. Giants HDFC Bank and Reliance Industries fell to 11th and 12th, dropping below 0.8. The capital leaving those Indian positions is migrating rapidly to Taiwan and South Korea. This chart shows the index's current composition. The top 10 is nearly completely dominated by 4 specific companies: Taiwan Semiconductor, Samsung, SK Hynix, and Tencent. Together, they now command 30% of the entire benchmark. This concentration tracks directly with the expansion of large language models and the data centers required to train them. Every generative AI operation requires physical processors. TSMC manufactures most of the world's advanced chips, while Samsung and SK Hynix supply the memory components that make these systems possible. As capital pours into the AI sector, the market values of these specific suppliers surge. Because the index strictly follows market value, it must automatically assign them heavier weights. They physically absorb a larger share of the fund. The money moving through global markets is ultimately chasing silicon wafers and fabrication capacity. The benchmark is no longer tracking broad economic development. It is acting as a ledger for the companies manufacturing the hardware of the AI era. India lacks a material footprint in that specialized hardware supply chain. It cannot capture the capital flowing into AI hardware. This chart illustrates the resulting performance gap. Over the first 5 months of 2026, the tech-heavy MSCI Emerging Markets Index climbed over 25%. Over that same period, India's domestic Nifty index dropped 11.8 lakh crore rupees from Indian equities this year. But the passive mechanics of the index compound the issue. Because the tech surge has diluted India's total share of the benchmark down to 10.8%, fund managers whose portfolios track the index must automatically sell their Indian holdings just to maintain mathematical alignment. Even investors with a positive view of India's domestic economy end up holding less of it. The country is being displaced by a global technology cycle it is not equipped to ride. This changes the nature of the investment for anyone buying the MSCI Emerging Markets Fund today. Buying this fund no longer provides broad access to domestic consumption, commodity demand, or local growth in the developing world. Instead, an investor is buying a concentrated, specific position in the global artificial intelligence capital expenditure cycle. This dynamic creates a serious structural vulnerability. If global spending on AI data centers slows down, an investor holding this fund will face losses for reasons entirely disconnected from the health of emerging market economies. The title of this fund promises broad emerging market diversification. The mathematical reality delivers a volatile bet on Asian technology hardware. The term emerging markets was defined in the 1980s to group together lower-income countries with fast growth rates as they caught up to the industrialized world. This diagram shows how fractured that logic has become. We are forcing Taiwan's processors into the same category as Brazil's agriculture and Saudi Arabia's oil. Take South Korea. It operates as a global tech hub, yet the financial world classifies it as a developing market. That specific classification may very well soon end. There is currently a 60% probability that South Korea will be officially promoted to the developed markets watch list this month. The rigid economic boundaries drawn by financial institutions 40 years ago can no longer contain the current global reality. India dropping out of the top 10 is not an error in the system. It is the system accurately reflecting that the traditional line between emerging and developed nations has fractured. The benchmark is skewed today because some of these emerging markets have in fact already emerged.